In retirement, how you withdraw money from your portfolio connects directly to how you have it invested. You need to stratify your investment approach based on when you're going to need the money. We call that the personal pension plan. The question is, fantastic question from a fan of the channel. Listen, as I implement that and then start withdrawing money from my short-term bucket, how do I replenish that? How do I do that without just timing the market or running out of cash? I've got that and more coming up. How you invest your portfolio, right? As you're approaching retirement, as you enter retirement, guys, this is one of the biggest financial decisions you're going to make in your life. And yes, it's true. Your investment strategy, your investment allocation, the risk you take, it's important, throughout your entire career and your investing experience. But certainly at retirement, when the stakes are enormous, right? You've never had this much money. You're about to make the biggest financial decision of your life, stepping away from your paycheck. How you invest, critically important. And it's not just a decision. Guys, it's a process, because despite what's going on in the markets, you've got to stick to that resolve and say, no, this is my disciplined approach. This is the process. But also, as you start withdrawing dollars, that process needs to lead you to, all right, how do I continually update and make sure that my portfolio isn't becoming out of balance, okay? We call this the personal pension plan. And what that means is, as you approach retirement, as you're looking at your overall investment strategy, it's not just reading the tea leaves or which way is the wind blowing or what's my hunch on the investment world. It is, all right, wait a second. I'm investing for this goal for retirement, stepping away from my paycheck. How much withdrawal do I need to take from my portfolio on a monthly basis, if you're setting up monthly, but regardless, like how much are you going to be withdrawing? And determining from that number, well, how much then do I expect to withdraw from my portfolio in the next 2 to 3 years? That money is your short-term bucket, okay? That's your short-term bucket. Those dollars, because they're short-term, they should be in short-term investments. They shouldn't be in the stock market, right? That's a long-term investment. But dollars that you're going to withdraw in the next 2 to 3 years, those should be in short-term. So maybe a high-yield money market, maybe a small CD ladder, something like that. That's where you're going to be drawing dollars from. Say you're withdrawing, $2,500 a month from your portfolio. So you need 30 grand a year. You need maybe $90,000 to $100,000 in that short-term bucket in high yield money market, CD ladder, that sort of thing. Then the 5 to 7 years after that, okay? So years 3 to years 10 should be in your intermediate term. In this bucket, you're okay to start taking some risk, right? But at the same time, you want to have some downside protection. It's very possible when you look back at the historical market returns, there are times when the stock market faces a pretty big downfall and still takes a few years to recover. So it's not out of the question that even though you've got 3 years worth of cash, once you spend through that and you get to that intermediate term bucket, maybe if we've seen a really bad market experience, those dollars are still underwater. No, you want to have some downside protection. You might want some income producing investments there. Maybe you're continuing a bond ladder in that strategy, maybe also use some hedging, but all of that is calculated from the dollars that you're going to need to touch from years 3 to years 10. And that way, you've got your short-term bucket, you've got your intermediate term bucket, and mathematically that covers your cash need for 10 years. Very rarely, it's possible, lost decades are possible, but very rarely, especially if you have a diversified portfolio, if you give your dollars 10 years or more to go to work for you, very rarely after 10 years have they not grown, and have they not grown meaningfully. So it's then that the dollars that you're not going to touch for 10 plus years, you invest those in a diversified strategy that's there to kind of fight inflation and grow for the long term. That's your growth bucket. Now we call that the personal pension plan. Others call it a buckets of money approach. It's fantastic, keeps the emotion out of it, and helps you face this crucial period in your life. Hopefully a fun period, right? Your retirement, but with confidence in the face of all the market uncertainty. Toby, fan of the channel, asked a fantastic question about, well, how do you rebalance? As I draw money, as I retire and I start drawing money out of that short-term bucket number 1, how do I rebalance? If I rebalance opportunistically, then I'm timing the market and threatening my portfolio diversity, especially in a market downturn. But if I rebalance blindly or unemotionally, then the effect is that I'm just selling away my stocks. What do you do? This is a fantastic question and extremely practical as well. right? If you set up this personal pension plan approach and you maybe then look at your entire portfolio, if you look through these strategies, you're going to have a certain percentage of stock and bond, and that's all going to make sense for your specific situation. But think about it. As you start spending through bank account number one, your overall allocation for your portfolio actually is increasing risk, right? You're spending down bucket number one, so your overall allocation to stocks, long-term bucket, compared to bonds or cash, short-term, is starting, your stocks are going up, right? You're increasing your risk as you go. Well, then how do you rebalance? And plus, you're kind of depleting your bank account number one. In an ideal scenario, and this is why you've got to work with your CFP. There's a lot of science here, but there's a little bit of art as well. You got to work with your CFP on your individualized financial situation. But in an ideal scenario, you are spending through that cash, bucket number one, okay? And that CD then matures. You've got your first CD. So now you're down to, maybe 2 years, maybe 1 year as you spend through bank account number one, and you simply just waterfall, where you then take some of your hedging strategies after a year or two, and they, hopefully haven't had some downside that they've had to protect against. They've participated in the upside up to a cap. And as you start spending through, maybe after a year or so, spending through your short-term bucket, you then kind of carve off a little bit of that growth from your intermediate term bucket, and you replenish that and put that into a 2-year CD. And so you're continuing to replenish bank account number one. And then you're doing the same thing with your long-term bucket and say, well, I'm not being emotional about my stocks. I'm also not timing the market. I'm taking a slice of my 10-year plus money, my growth portfolio. I'm adding that back into hedges because I took some of my hedges, my intermediate term, and replenished my short-term bucket. It's just sort of a waterfall. And ideally, guys, that's what you would do. Okay, you wouldn't be opportunistic and what's the market doing? What's the market not doing? Blah, blah, blah. You would just kind of close your eyes and do that once a year, maybe every 2 years, because you've got that short term and intermediate term. You've got a nice moat around your financial castle. It doesn't take a lot of maintenance, but in an ideal situation, you don't need to, be opportunistic or get too creative, get too cute. It's just sort of a waterfall. And you move money from your intermediate to your short term and from your long term to your intermediate. Now, we've been implementing this strategy, helping thousands of people with this sort of clarity and confidence when it comes to investing for their retirement. How often do we follow that idealistic approach? 50 to maybe 75% of the time. What do we do instead, right? 25 to 50% of the time, that's a large margin. What do we do instead? We are opportunistic. I'm being opportunistic right now. And yes, Toby, you're right. It does feel a little bit like timing the market, but again, it's designed to manage risk for your overall portfolio. In this strange sequence of events here, somehow stocks are still near or at long-term, all-time highs, depending on when you're watching this. But stock market's actually gotten a little bit cheaper because earnings have been, relative to earnings, because earnings have been so fantastic, right? If you look at the Shiller PE, nope, we are at threatening levels, too high. But forward PE, things have gotten a little bit cheaper. But all that said, your long-term bucket, that 10 plus year money, has likely far surpassed expectations. It's grown far more than a normal situation over the past, year to date and the past 2-3 years. Therefore, for many people, we are lopping off some of the growth from that long-term bucket, bypassing going to bucket number two, intermediate, and instead taking some of the growth and putting it right down, replenishing bucket number one, your short-term bucket. Yes, it's being opportunistic, and in a way it's sort of market timing, but it is a way to rebalance your entire portfolio back to the strategies and the overall risk tolerance and mix that is appropriate for you. You're just capitalizing on this incredible short-term run that we've had in the stock market. So like I said, there's a lot of signs to this. And if you're facing retirement, you're near retirement, you don't have a strategy like this, personal pension plan set up, run. Don't walk to your certified financial planner. Reach out to us. We're happy to help you with this and implement this. Guys, it gives you so much clarity and confidence in the face of the uncertain markets and at a time when you're making the biggest financial decision and want to be sort of not worried about your investments. The investment should be working for you. But yes, guys, it's part science and a little bit of art as well. Depends on your situation, depends on what the market's doing. Ideally, you are doing that idealistic, the long-term bucket flows to the intermediate term bucket, which flows to the short-term bucket. but you may want to be opportunistic just depending on the situation and your circumstances as well. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.